Welcome to the daily update, where I'll go over the action in the market for Thursday, August 7th, and we'll see how things look for Friday, August 8th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, kind of a disappointing day. The market could have really taken off and moved to the upside. There was some news that the tech sector liked, semiconductors liked. That could have really fueled things. It did, at least at the start, but we set the high right at the open again, and then spent the rest of the day going down, seeing selling into strength. A little bit of a bounce up going into the close, but not really anything to change it back. We ended up closing down slightly. So we're still kind of seeing any news coming out right now is treated more as negative, even when it could be taken as positive. Now, go back about a month or so ago, any news that was coming out was treated as positive. Even if it was negative, it was switched around and turned as positive. Well, now we're into that seasonal time during a post-election year especially, where August and September are usually fairly weak. And we're not really seeing any real weakness yet. We could still break to the upside and do a contrarian move based on what we've seasonally done during this time. But we're not seeing a lot of conviction. In the short term, we have no indicators that are extreme positive or negative right now. They're just kind of chopping around. But the bar pattern that we're seeing, that's still looking healthy, and I'll point that out as I go through this. Okay, so right at the open, we had a gap higher open. We were looking pretty positive there. We opened at R2 at 63.85. That set the high right there. Then we declined. We got below R1 at 63.65. Then we dropped negative. We went down below the unchanged level, and we did find support, at least for a while, at the daily pivot at 63.33. Then we tried to bounce up off of the daily pivot, but we hit resistance at the unchanged level. That's a built-in this case, resistance level when we're below it. When we're coming down, quite often it can act as a support level. That's why I bring it up in the description of the price of what happened, because it can be that support or resistance level pretty much at any time. And then we tried to get positive again. That didn't work. So then we declined back below the daily pivot. Then we went down to S1. So we fell even lower at 63.13. But then we did rebound up off of S1, and we closed slightly negative, just and back above the daily pivot. So we were just down 0.08%. But it wasn't that big of a move on a percentage basis. But to see the intraday action that I'll bring up here in a moment, it's discouraging if you're more positive on things right now. We were still above average with volume, though. We've been seeing fairly good participation on that level, and we're still positive. We're above the 20-period moving average in the short term. We're still positive in the intermediate and long term. Interest rates are going back up. We're seeing the dollar declining. That didn't seem to help stocks too much. Maybe it helped them from declining more. And there's a lot of announcements and things going on and shifting that's taking place even at the Fed level. So, some comments. There were early gains after there was this announcement that came out that they're going to exempt semiconductor tariffs. And it's like, okay, the market could have just skyrocketed on that. But we saw those gains, and the tech sector and semis ended up doing okay. They were actually negative, at least the tech sector was for a while, but it ended up closing positive, where the NASDAQ and NASDAQ 100 were slightly up, with the S&P being slightly down. But this was surrendered right after the open, and we saw fairly broad-based selling. Then Fed Governor Chris Waller is emerging as a top choice of the Fed chair. That's the pool that Trump has to choose from for that. Then President Trump also announced that he selected Dr. Stephen Moran. I have no idea about this person, to serve in Adriana Kugler's just vacated seat. And this is a temporary position for right now. and that'll last until January 31st, 2026. And as I said earlier, the NASDAQ and NASDAQ 100 did advance while the S&P declined. Because NASDAQ and NASDAQ 100, they're more growth, where we see more of a balance in the S&P between growth and value. The VIX did decline on a down day. That usually doesn't happen. If the VIX is down, stocks are up. If the VIX is up, stocks are down. Once in a while, they get a little bit out of line with each other, and that's what happened on Thursday. And we're still above the 20-period moving average, so we're holding on to that level. And then tech had not a great day, but they had a better day than the rest of the market. No changes to the overall scenario. Now there's a lot of this employment debate going back and forth because last Friday's employment report was quite weaker than expected, including the revisions to prior months. And it's like, okay, maybe things aren't as good as we thought they were. And my understanding is that Dr. Stephen Moran is more dovish with things. So if you remember back to the Fed meeting last week, there were two of the committee members who wanted to have a 25 basis point cut. And Dr. Stephen Moran might be in that camp. So there would be three there. But is that a good thing to do? Is employment really starting to weaken, or are we lowering interest rates because the economy is really starting to falter? All right, then the dollar was down, interest rates were up. I think I said interest rates were down. I meant to say they were up. We're at 4.24%. This should be 4.22%. We just climbed 2 basis points there. Sentiment hasn't changed, and we're still at 55, which is positive. This is right on the border between positive and neutral. And the overall context is we've been coming down. We have little up days here and there, but the market's not showing an awful lot of conviction right now. We're still positive with our trend, and it's a weakening trend, though. It's declining below its moving average, and I kept the biases positive because the late day, even though we closed down a little bit, usually if we have an up day, it's bias is positive, down day negative, but the late day bounce to take us back almost to the unchanged level. That's why I kept that positive. And looking at everything together over the last number of days, we're still mixed to positive for the time being. So the reports that came out, this was probably the biggest day of the week as far as economic reports. Second quarter productivity came in greater than expected. Now that's good when you have people producing more. That was up 2.4%. They thought it would come in up 2.2%. Last time it declined 1.8%. Unit labor costs a little bit more, so now they're having to pay more here for this increase in productivity, which is great if you're an employee. It sucks if you're an employer. So the preliminary reading came in at 1.6%. They thought it would come in up 1.5%. Last time it was up 6.9%. And then jobless claims, now we're still range bound for the time being, but we did tick back up at 226,000. They had thought 220,000 would come in. Last week we saw 219,000. So we're not really breaking out there. What's a little bit more concerning on one hand is that we're still hovering kind of at higher levels in the range when we look at continuing claims. So people aren't letting people go, but the people that do lose their jobs are having a more difficult time finding a job. We're below the 2 million mark. That's the positive side, but we're still hovering at pretty high levels overall. And I'll show you that chart as well. Wholesale inventories were up 0.1%. They thought they would be up 0.2%. Last time they were down 0.3%. Then consumer credit increased by 7.4 billion. That was less than the increase of 8.6 billion that was expected. Last time it was up 5.1 billion. All right, so here are the weekly claims, which went up here, but the moving average, even though it's slowing down, is still continuing to decline. And if you look at this over the last few years, you can see that we are fairly range bound with this. This is a little bit more of a concern, where we have the continuing claims. We're still below the 2 million mark here, but we're continuing to go up after we had been range bound for 2024 and a lot of 2025. Now that this is going up, that's producing some more concerns. So we put it together where we saw an increase in the initial claims, that's in red, also an increase here in the continuing claims, and then a week ago we had the unemployment rate adjusted again to 4.2%. Productivity here and unit labor costs, where we're seeing productivity flattening out here on a year-over-year basis, but it's still positive. Where we're seeing unit labor costs, the yellow line, that's actually going up, and that could be somewhat inflationary, which you like this if you're an employee. Consumer credit on a year-over-year basis, after it had been negative, now it's starting to go back up. And then the month-over-month change did increase from the previous month's reading. And wholesale inventories, they were negative in the last reading that we had. Now they're going back and looking positive, but not seeing anything all that big at this point. Then some Isabel Net blog charts, and I know Real Investment Advice has been making a pretty big deal about this. It says deviations of earnings either above or below long-term growth trend. This is just suggesting that we're overvalued, but we see that. Even I go through on the weekend, I do the intermarket analysis video, and we do valuations looking historically and looking forward. We've been overvalued now for quite some time, and I don't know how helpful this chart is, because you can look back and say, oh yeah, we were overvalued at that time and then we went down. Well, we've been overvalued for a while and we've been going up. So it's not really much of a timing mechanism. It's more informational. It's the way I take this. All right, not too hot, not too cold. When you take a lot of the different sentiment gauges together, at least before Thursday's session, coming in at 54.9, where we have the AAII chart, which I'll show you later. We follow the VIX very closely, and there's a lot of other different sentiment gauges on a weekly basis, the active asset managers and so forth, and then they average all of these together. So they're, at least when you do it this way, it's looking more Goldilocks at this time. And valuations still near all-time highs. Yes, we've known this, and it's been this way for quite a while. This is a Bloomberg chart here, looking at the forward PE ratio and different mechanisms that are treated together. And you go back to 1929, of course, that's the big stock market crash. Then we had the dot-com boom, followed by the dot-com bust. And who knows? I mean, there were, if you've ever studied much about the 1929 crash, there was just so much leverage at that point. And I mean, you only had to put down like 10% to buy 100% of stock. You could borrow 90%. So if things went against you, you went broke really quick. In 1999, yeah, there was the dot-com boom, but there were no earnings behind these companies. Are we still looking more solid now? You can make a case, you can draw up all these charts and try to make a comparison to where we're at now versus either 1999 or 1929. But you could also make a case against that at the same time. All right, then Deutsche Bank Fed forecast versus the alternatives. They have these red diamonds here. That's Deutsche Bank. That's their projections, a little bit higher. Where the blue triangles, I like how they use all these different types of shapes here. They actually are showing still a rate cut here. And then this is what the market is predicting. They're going more with what the Fed is starting to predict. All right, then earnings sentiment still looking pretty positive here, especially when you look at the solid blue line right here. That's the S&P. These are how are people feeling about earnings, not necessarily actual earnings. And then the recent mutual fund and ETF flows, we're seeing a lot of money still going into money markets that's not necessarily on the sidelines to go into the stock market. For a lot of folks, they put money into a money market, and that's as far as it goes because they get a better return. It's still very liquid, and they do much better than if you put the money in a bank. Where we're seeing some increase here in bonds as they've been performing better in 2025, and less money going into equities, but still an awful lot. Then looking at the projection of this, it says market pricing reflects SEP premium and higher likelihood of cuts under Powell's successor. This is all just speculation at this point. They crunch a number together, and they think that once Powell is gone and whoever comes next, there's more of a likelihood that there's going to be rate cuts. Who knows? I mean, the economy could be totally different. The world could be in a completely different situation by then. And then market implied U.S. recession probability by indicator. I just look at the average overall, about a 21% chance. That means there's a 79% chance that there's not going to be a recession when you look at all these different indicators that we follow. And the market's still anticipating that we're not going to go into a recession. And I go over that in the weekend videos. And then stocks soar following the and about 20% drop. Yeah, this just is showing what they're trying to do is make another comparison here. They index it back to 2020 and they compare 2020 to 2025, where we had the big drop in March and into April, and how we've kind of been tracking along with that since that time. All right, frequency of earnings beats and misses. And again, companies tend to lowball this so that when their report comes out, it's like, oh, they beat estimates. And, oh, aren't we great? Isn't our company fantastic? Maybe our stock price will go up. And that's happening 63% of the time, where 10% of the time they're actually missing their estimates. Then margin debt versus the Wilshire 5000. Now I show a chart in every daily video of the Wilshire. That's a broad market measure that we look at. And there's not 5,000 stocks in the Wilshire. When they first created it, there was, but there's like, I think 1,500 or something now. And then comparing it to margin debt, when people are borrowing money to buy more stock. And you can see other times here when we really saw this going up and then top out. That's about when the market topped out. And you can see a top and a top. And then in 2020, a top and a top. Now, it's not really getting all that crazy right now, but it says historically margin debt tends to rise with equities, supporting bullish trends rather than derailing them. It's just more money being fueled into the market. The real risk comes when leverage starts to unwind. And we're seeing it ticking down a little bit here. Some of that could be some leftover from last spring when we were really going down. And so again, when you borrow on margin, it's not like you're doing a 50-50 deal with your broker. I mean, if you borrow, you want to buy $20,000 worth of stock, and then you borrow 10,000 of that to buy more stock, you've got to pay that 10,000 back. It's like if that stock drops to 15, you're not going to pay 7,500 back to your broker. You still have to pay 10,000 back to your broker. So they're in it for the full amount, where that can really lessen your returns and actually accelerate your losses if you end up being wrong. It says here we would worry if margin debt declines while the S&P rallies. And this is a pattern, excuse me. This is a pattern that we saw in 2000. That's when we topped out with the S&P, then went into the dot-com bust. 2007, we were setting all-time highs. Then we went into the financial crisis, the pretty big downturn that we saw in 2018, and then 2019, and then late 2021, which then we went into the bear market in 2022. Okay, but this is only updated once a quarter. It's put out by FINRA. So yeah, we'll watch this, but I'm not sure we can really use this as a timing mechanism. We might know about this after the fact. We have to look in other areas to really evaluate where things are. Okay, then implied versus realized volatility. Now, implied is looking forward at what they think volatility is going to be. Realized, I usually call this historical volatility as well. Investors are jumping. Markets expect higher volatility than what we've seen lately. We just see this lighter blue line here above the darker, like purplish line here, where a lot of times we see just a reverse of that. And we saw that in the volatility risk premium. We were getting really high readings a week ago. It's coming down a little bit now, but it was really topping out. And then we had the big down day. We had the higher open last Thursday, and then the sell-off, and then we had the gap lower open on Friday. And that was being picked up, not by the VIX, not by other sentiment gauges that we look at. It was being picked up by the volatility risk premium chart that we show. And then revenue per employee. It takes 1.55 employees for S&P 500 companies to generate a whopping $1 million of revenue. In 1991, that same million took 2.46 employees. So because of automation and advances in technology, and then now you're going to have AI coming into the picture, it's going to take fewer people to do more. At least that's what's being projected here on this chart. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, so here is the intraday chart. Set the high pretty much right at the open here, right at R2, and that was as high as we went, and then we started to drift down. This is where we dropped down below the unchanged level. It tried to hold up there for a little bit, and then we dropped down to the daily pivot. The cool thing about this is this line was on the chart even before the day opened, and we did bounce back up, but now the unchanged level became a resistance level. We dropped down below the daily pivot, came down to S1, that held, and then we did see a little bit of buying going into the close, at least to get us back above the daily pivot, even though we did close down negative. All right, and we're up a little bit. We've been seeing the futures fairly strong, and then we quite often lately will have a pretty good open, but then we set the high right at the open and then go down from there. That's over the last couple of weeks, we've seen that happening periodically. And we're still looking good here with our intraday growth to value chart, the blue lines above the red line. And still looking okay here with the longer term look of S&P growth to value. Then our end of day charts, growth was down where value was actually up a little bit. Growth was down more with the mid caps and down more with the small caps. So not a real good day for growth, even though it was a fairly good day, relatively speaking, for tech. So just kind of chopping along still with our small cap growth to value ratio. Declined a little bit here with the mid cap growth to value ratio. Still looking good in the bigger picture, but we declined with the S&P growth to value ratio. This looked pretty good though. The growth to value ETFs, that's actually breaking out a little bit there. And came down a little bit, but we're still positive with the discretionary to staples ratio. And we're still showing a weakening trend, but it's positive with the green line above the red line. And we're trying to turn up a little bit here with the short-term ADX, but we have a long ways to go just to get back to the moving average. Also below the moving average in the intermediate term with the green line going up and the red line going down. And we were slightly above average with volume here. A little bit of a green here with the histogram. And then sentiment, we're still below 20 with the VIX. And that actually came down a little bit on a closing basis, and the bar chart was a little bit lower with its range. But this is when we typically see higher seasonality for the VIX, or seasonality is higher for the VIX at this point. And when the VIX is going up, that typically means stocks are going down. And right about at the moving averages here with the VIX of the VIX, a little bit above it here on a closing basis. So we saw a little bit of an increase there. And we're just a little bit below the range with the skew index. This is a variation of the VIX. The market's still expecting some kind of a big move. We haven't quite dropped down from this range yet. We're just a little bit below it currently. And we ticked up a little bit with this fear gauge, and we ticked up with this other fear gauge, even though the VIX was down on a closing basis. And then every week we get the individual investors. They're actually a little bit more pessimistic now. And this is a week old. They do their survey over last weekend, and then it's reported. I usually get this chart on Fridays. And then we came down with the daily chart of the equity put call ratio. We're actually back to declining with the 5-day chart, but we're still going up with the 10-day chart. And we're still going down here with the high beta to low beta ratio. You would think this would be going up, but no, it's actually declining. This is a little bit of a warning sign to us. When the market's more positive, this ratio goes up. And this is the volatility risk premium chart. See how we were getting a really high reading? We've been coming down since that time, but this happened right before we saw the lower close on Thursday and then the gap lower on Friday. We were getting a very high reading here. Our advanced decline line studies, not much of a change, either based on price or volume, but they're still well above the advancing moving averages. We're still below zero with the 10-day advanced decline oscillator, so that's more negative. And in the short term, we're dropping below the midpoint here with the advanced decline ratio. We decline, but we're still above the midpoint with the intermediate term advanced decline ratio. And we're declining more now internally. We're seeing a dropping off of the new highs. Not much of an expansion of the new lows. It's more of a contraction of the new highs. So the 5-day chart is going down and the 10-day chart is going down as well. And take your pick here. We're kind of right on top of the moving average. You could call that positive. We came down, but we're right on top of the moving average here with the boom indicator. And this is switching over a little bit. This is longer term, and this is more of a shorter term way of looking at accumulation distribution as it's interacting with the moving average. Still declining with the Chaikin money flow, but we're still positive with the Chaikin oscillator. So we're getting some mixed signals there. We declined with the vortex, but the green line is still above the red line. And we're seeing a little bit of a disconnect. Now, this is not a true comparison. This is the S&P 500 with the NYSE advanced decline line, where this bar pattern here is still holding up. You can see a series of higher highs and higher lows for right now. We came back, we filled this gap, and we were pretty much gap bound. And it looked like maybe we were going to finally break above this gap, but then we set the high right after the open and then closed well off of that. But then we look at the red line, the NYSE advanced decline line. It's actually been coming down and underperforming as the bar pattern anyway for the S&P has been looking a little bit more healthy. So that's a bit of a negative divergence that I'm picking out here. We're still above the moving average with the NYSE common stock advanced decline line and still above it with the S&P. And excuse me, the S&P is up here. Mid caps are still above it, and we're starting to drop below it with the small caps. And it's still below zero with those stocks in the S&P above their 20-period moving averages. Ticked up a little bit, but below 50, it's considered negative. We ticked up a little bit with the 50-period moving average study, the 100-period moving average study, but we were pretty much flat with the 200-period moving average study. Slight increase there. Then here is the chart too, also showing the higher highs and higher lows. We're above this pivot point for right now. We're still in an uptrend, slightly above average with volume. A little bit of an improvement with the 20-period and 50-period moving average study. We were flat with the 200-period moving average on the S&P. And this is where we're not really seeing any conviction. We're below the midpoint with the Stochk RSI. We're above the midpoint with the Williams percent R, above the midpoint with the CCI 14, and slightly above with the CCI 20. But we're not getting any extreme readings currently, and not extreme with the stochastic chart. This is usually always on the list. We're above the midpoint in the short term. We're bouncing up and showing some improvement in the intermediate short term, but we're declining and no longer extreme positive in the long short term. And just barely above zero here with the force index. Now, these Keltner bands are getting kind of close again to each other, and that could be like winding a spring. The more you wind it, the more the breakout could be. But we don't really know when that's going to happen. Still seeing a little bit more vulnerability with the short-term trend. Based on 20 periods, we're below the lines, so the lines had been going up. They're flattening out. Now, if we can get back above this, that will really help it, of course. But for right now, it just shows a real slowdown that we've been seeing. We're still above the 20-period simple and exponential moving averages. So that's holding, and that's why we're positive in the short term. Still above the midpoint in the +1 channel with the standard deviations chart. Still negative here, the balance of power. It continues to be below zero. It turned up a little bit, but we were picking out that negative divergence that was happening as we ended July here. The S&P was going up as the balance of power was going down. And this is redrawn again, looking a little more positive with the go, no go, with the darker blue bars. Still above the midpoint with the highest high, lowest low value chart. This is still getting long. We're up to day 68 now when we started a new uptrend right at the beginning of May, according to the Landry Light system. And we're also still positive here with the proper order. That hasn't changed. Still seeing more of a negative divergence. We were going up with the S&P. We were going down with the TTM squeeze. Now that we're trying to go back up and filling this gap, the TTM squeeze is continuing to decline. And just barely above zero here with the ease of movement. Dropping off a little bit, but still positive with the Arun. Shows that there's more buyers than sellers, even though the buyers are starting to decrease. And still below zero with the S&P McClellan oscillator. So we're going down with the summation index based on price and volume. Still below zero with the NYSE McClellan oscillator. So we're declining with the summation index based on price and volume for the NYSE. But we're still looking positive with the Sutherland Trading Oscillator. It's going up based on price and volume. Still below zero, but I tend to look more at what's the direction of the lines. And we're no longer extreme. We just barely came down below the red line here with the PMO, but we're below the moving average and we are declining. That's negative. We're also declining based on price and volume with the PMO. Still below 50 with the PMOs that are rising. And still below 50, kind of trailing off here with the buy signals and seeing a little bit more weakness creeping in when we look at the PMOs inside the S&P that are above zero. And positive, though, with the Elder's Impulse system. Still getting a green bar there. And still negative with the parabolic SAR. So how's that for not really having much conviction? Still looking negative with the short-term slope oscillator. We're below the green line. We're below the moving average. The MACD continues to be negative as well. And now we're not extreme with any of our oscillators anymore, but they're all negative across the short, intermediate, and long term. They're all drifting lower. And we're also lower with the Copic curve. That's negative. And we came up just a little bit here with the Sean trend meter. Above 50 with the money flow, below 50 with the ultimate oscillator, above the moving average with on-balance volume. And this is holding up. The RSI, we're still above 50 here with the intermediate term chart. And we're also above 50 with the short-term chart based on 9 periods. And kind of dangling around in these moving averages. We're getting, at least we were above it. We closed pretty much right on it with the 10-period simple moving average. That's the green line. But it's really starting to flatten out. We're above the orange line, which is the 20-period exponential moving average, and still above the 30-period exponential moving average. So these lines are still positive, but they're really slowing down. Intermediate term trend, we spent a few days now, 1, 2, 3, 4, now 5 trading days below both lines. The red line's starting to really flatten out, and the blue line is still going up, but it's slowing down. So that's showing a little bit more vulnerability to the intermediate term trend. But we're still above all the moving averages here, and the moving averages continue to go up. And we're still above this anchored moving average going back to the gap that we saw when the market really was breaking out a bit, not trending, and then going to the upside here. We're still above that level. If we do start to fall, this is one of the first levels that we'll be watching in addition to the 20-period moving average. And we're still declining with the bullish percent index. We're going down and we're below the moving average. A little bit of a tick down, but still above 50 with the NYSE bullish percent index. So that's why I'm counting this as positive since it's above 50. And we're below 50 and declining with the NASDAQ 100 bullish percent index. Still kind of hanging around this mini rainbow here with the 20-period simple moving average of the open, high, low, close. We closed right at the moving average of the high. And we're still below this R1 pivot point. This is a weekly chart. And if we don't go down more than 1.63% in Friday's session, we'll end up having an up week. And looking kind of positive here, but really slowing down with the Heiken Ashi, but it's still giving us an uptrend there. We're still in an uptrend with the Kigi chart. We're actually turning more negative with the Renko chart. It's drawing in a red box, and we're looking more negative with the 3-line break. So we have 2 that are more positive, 2 that are more negative. Long term, we're still looking okay longer term with the 150 and 200 period moving averages. And we're still negative in the short term with the mid caps. All the other indexes are positive on all time frames. And bonds are still positive in the short and intermediate term. Commodities are negative in the short term, and the dollar is negative on all time frames. So we see utilities, staples, okay, that's more defensive there, where discretionary was down, but it underperformed staples. And then we have other defensive areas like healthcare and the financials. We're getting concerned about that. I'll show you the chart later. The ratio between the financial sector and the S&P is continuing to show more weakness. So not an awful lot of conviction here, but utilities ended up being the strongest area, and that's considered more defensive. So we had utilities first. They had a BPI cross below 80, but then they bounced up from that. Canada's setting another new all-time high. NASDAQ at least setting a high. It was up on the day, as was the NASDAQ 100. Discretionary had a BPI cross below 70. That's more growth, and that's showing some weakness. Where the NASDAQ got above 21.2, then it dropped below 21.1, and the Dow dropped below 44,000. So we saw, and Apple's still kind of riding that wave. So it was up, Nvidia was up slightly, but then Microsoft ended up being down. So not an awful lot of positive conviction here, especially with the bigger charts, kind of a mixed picture. But you can see the financials, pretty much all red with a few exceptions. Discretionary had Amazon up slightly, Tesla was up slightly as well. And Eli Lilly, that's really what drug the healthcare sector down. Their earnings report was not really, no, it was a drug test that was not well received. And so Meta was down where Google was slightly up. We're just seeing really small moves here. And we're also seeing another bit of a disconnect. We see the S&P weighted index going up and still looking pretty healthy. The equal weight is actually starting to underperform. And the Dow was down over 0.5%, but it's still above its 50-day moving average and still in an uptrend. But we've gone from neutral over to negative with the diamonds. And we're looking okay here with the NASDAQ. It was up 0.35%, still above this pivot point, still in an uptrend. And we're still positive with the NASDAQ with the Elder's Impulse system, with the NASDAQ 100 also up 0.32% above this pivot point, still in an uptrend. And positive with the Elder's Impulse system when we look at the Qs. But the momentum continues to drift down. And we've been seeing that pretty much going back to the beginning of June. We really started to see this drift down as we were going sideways. And then even when we were breaking to the upside, there was a little bit of a improvement here with the PPO, but then it started to drift down from there. Still dealing with this longer term trend line. We've been dealing with this for quite a while now. This is the weekly chart of the NASDAQ going back to 2009, NASDAQ 100 going back to 2009. And we are below the 200-day moving average with the S&P small caps. And a ways to go here to generate a golden cross, where we did just generate a recent golden cross with the Russell 2000 small caps. And neutral with the small caps with the Elder's Impulse system, kind of chopping along sideways in an uptrend here with the mid caps. Still negative with the bar there for the mid caps when looking at the Elder's Impulse system. Kind of chopping along here with the Wilshire 5000. That's the index that I showed earlier when we were looking at margin. And still not quite back to highs here, but still in an uptrend with the total U.S. stock ETF. Financial sector still looking okay. Now it's down over 1%, dropping below its 50-day moving average, but the trend is still fairly intact. But we're really underperforming when we do the ratio. It's continuing to go down, and we just generated a death cross with this ratio. And kind of chopping along sideways here with the FANG index, the really big stocks. So Apple continues to ride that wave of the iPhones being produced in India, not being subject to tariffs. It was up another 3.18%. Amazon was up a little bit above its 50-day moving average. Microsoft was down, but still in a longer-term uptrend. Google was up a little bit here, also in an uptrend. Meta was down another 1.33%, but still in an uptrend. Tesla just kind of chopping around still around its moving averages. NVIDIA was up 0.75%. I'm not sure if that might have been an intraday high. I'm not sure if that's a closing high there. And then Netflix was little change, still below its 50-day moving average. And then the semiconductors, not quite back to an all-time high, but they were up 1%. And they benefited from the news that broke on Thursday. And so this is still looking pretty solid with the Dow Jones Semiconductor Index. The SMH Semiconductor ETF also was up over 1.5%. Still coming to the high end of the rainbow with the SMH Semiconductor ETF. And we bounced back up here. Now, the context is that we've still been going down when we look at the ratio of semis to tech, but they did bounce back up in Thursday's session. And kind of a little bit of a change here with the short-term correlation between U.S. and world stocks, still drifting lower when we look at the longer-term correlation. Oil's continuing to drop. Now we're into the 63 range. And the dollar continues to be in a downtrend and is now dropping below its 50-day moving average. The latest reading from Truflation, they recalculate this every day at 1.75%. And we're still below the 4.5% level with the 10-year yield, even though interest rates did go up. And we're pretty much chopping sideways recently here with the 10-year based on price. And we're still a little bit above. We were back to even after Wednesday. After Thursday, we're back to being uninverted now, but we've been chopping all around this lately. We're not really seeing much conviction here when we look at the 10-year to 3-month yield curve. Still looking good here. The Qs did outperform the S&P. That showed a nice advance. A little bit above the moving average with discretionary to the S&P, and we're still looking okay when we compare large cap growth to value. So we're above the moving average with the large caps, mid caps, and even the small caps. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So what's the outlook then for Friday? We're still dealing with earnings season. We're positive on all time frames, but we're just not seeing a lot of conviction, and we are seeing some weakness that's coming into the market. And as I've been saying, now a good solid update could take care of that weakness, but the weakness kind of continues for right now. Is it going to develop into more of a decline? And we don't have any economic reports coming out on Friday, so there's really nothing to key off of that way. It might be any news that ends up coming out there, or as well as something geopolitical, that we always want to keep an eye on those things that might have an impact on the market. So no economic reports there. We're finished with this economic report calendar for the week. Seasonality, neutral to positive with the Dow and S&P for August 8th, neutral to negative with the NASDAQ. So not much of a real direction guide there. But we are seeing during post-election years. Now, this previous chart, this goes back to 2002, so it takes the last 22 years here. This is just looking at post-election years. This is where we're seeing some seasonal historical weakness, especially going into about the middle part of the month before we get a little bit of a bounce. And even when we get the bounce, we don't really see much of an improvement there. I'm following the green dashed line for this one, and we've been negative going back to 1950 during post-election years. So that doesn't bode well for historical norms. And also during post-election years, August tends to be a weaker month. This also shows a weakening time during post-election years, according to the Carson chart. So now I'm still keeping these on the negative side because we're getting a mixed picture. We're accumulation distribution, you could call it positive. We're kind of right on top of the moving average, both with the indicator and the boom indicator, where we're negative with the Chaikin money flow and we're still positive with the Chaikin oscillator. So it's like take your pick. We like all three of these to line up at the same time. We're still negative with the McClellan oscillator and summation indexes for the S&P and NYSE. Parabolic SAR is still negative, as is the 20-period moving average study since it's below 50. The bullish percent index, we're below 50 with the NASDAQ 100, and we're below the moving average with the S&P 500 bullish percent index. And we're flat out negative now and not extreme with our oscillators and Copic curve. The ease of movement, I have it negative. It's just barely positive for right now. Probably could have put that over on the positive side. The ultimate oscillator is still above 50, but the momentum for the NASDAQ 100 just continues to drift lower. And then we're getting close, and I'll show this over the weekend, and if we do see a cross here, where we're actually crossing over positive with the long-term special K, I'll show it a few times in the daily video, but because we only get maybe one signal a year or something with that, I just talk about it in this video. But if we actually see a change, we're still positive with the weekly chart, but if we switch over to positive with the daily chart, that would be longer-term positive. And the Zohorchak method. Now, we're not on a full-on sell signal now. It was at a -10, now it's at a -6. So it's improving, but it's still negative. So on the positive side, we're still holding up with our growth to value and discretionary to staples ratios. The swing trading oscillator, it's still picking up something that it likes, and it's advancing based on price and volume. The bullish percent index, because it's above 50 with the NYSE, the money flow is above 50. The vortex is positive. The financial sector is positive by itself, but it's really underperforming the S&P. And here are the pivot points for Friday. So our conclusion, we're still positive, and I base that around where we are in relation to the moving averages. It's a weakening trend in the short term. We're above the 20-period simple moving average, but we're just not seeing any conviction right now. And because of that lack of conviction, we're starting to see some weakness developing. Potential. Now, it is weakness, but whether it's going to lead to more declining prices, that's why I have a question mark here. We're still holding up quite well, though, for the time being with the long-term trend. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.